Alright, let's get one thing straight. If you're holding Tesla stock right now, you aren't just holding a car company. You aren't even just holding an AI company anymore. You are standing on the edge of the most massive, most chaotic, and frankly, the most dangerous corporate restructuring in history. I'm talking about the X Holdings monster, the rumored merger between Tesla and SpaceX. On the surface, it sounds like a sci-fi dream, right? The world's leading EV giant joining forces with the king of the stars. It's the ultimate Musk power move. But look at the market. While retail investors are cheering, the big institutional money is quietly heading for the exits. Why? Because what looks like a galactic synergy could actually be the biggest wealth transfer in history, and it might just be coming straight out of your pocket. We're talking about a $1.5 trillion IPO on one hand and a $20 billion CapEx explosion on the other. Something has to give. Today, we're digging into the 3 hidden landmines of this merger and the secret catalyst that explains why Elon is doing this now. Let's break it down. First, we have to talk about the numbers, and they are staggering. SpaceX is eyeing a summer 2026 IPO at a $1.5 trillion valuation. That would make it the largest debut in human history, eclipsing Saudi Aramco. Now, here is the problem for Tesla shareholders. Tesla's own valuation is already stretched thin, trading at a PE ratio that reflects infinite growth. If a merger happens, how do you value a private company that doesn't share its books against a public one that does? The landmine here is the merger ratio. Elon Musk owns a much larger slice of SpaceX than he does of Tesla. If he merges them, he has every incentive to value SpaceX as high as possible. For you, the Tesla shareholder, that means massive dilution. Your slice of the Tesla pie just got a whole lot smaller so that Elon could bring his space toys onto the public balance sheet. It's not a partnership, it's a takeover of your equity. Let's look at landmine number 2, the $20 billion question. Just days ago, Tesla's CFO dropped a bombshell. CapEx for 2026 is expected to exceed $20 billion. They are winding down the Model S and X lines to build the Optimus robot factory. That is a massive gamble. Now, imagine adding SpaceX to that balance sheet. SpaceX isn't cheap. Building Starship, launching 100,000 Starlink satellites, and planning Mars missions requires billions in cold, hard cash every single quarter. Wall Street is sniffing out a crisis. On one hand, you have Tesla trying to pivot to AI and robotics. On the other, you have SpaceX burning cash to colonize the moon. If they merge, Tesla's safety net of cash becomes the fuel for SpaceX's rockets. Investors are asking, am I buying a profitable AI company, or am I just funding Elon's Mars retirement plan? The moment those margins take a hit, the stock won't just dip, it'll crater. The third landmine is the one nobody wants to talk about, the self-dealing trap. In January 2026, 2 new merger sub-entities were registered in Nevada. The officers? SpaceX executives. This isn't a theory anymore. The pipes are being laid. But here's the kicker. Elon is essentially negotiating with himself. He controls the board at Tesla, and he is SpaceX. Institutional governance experts are already raising red flags. We are seeing the birth of X Holdings, a unified conglomerate where orbital data centers, humanoid robots, and EVs all sit on one balance sheet. If one part of the empire fails, say a Starship explosion or a massive FSD recall, it drags the whole ship down. You lose the silo protection. It's a concentration risk that could turn a portfolio-defining winner into a single point of failure nightmare. But wait, if this is so risky, why is Elon pushing for it now? Is he just greedy? Actually, the real story isn't about money. It's about physical AI infrastructure. Reframe the situation for a second. Tesla's biggest bottleneck for FSD and Optimus isn't software anymore. It's compute and power. You can't run a global fleet of millions of robots and cars on Earth's aging, fragile power grid. This is the secret weapon. SpaceX's plan for orbital data centers. Imagine thousands of Starlink satellites equipped with AI chips, powered by 24/7 solar energy in space, free from Earth's grid constraints. That is why the merger matters. Tesla provides the physical AI, the robots and cars, and SpaceX provides the celestial brain, the orbital compute. Elon isn't merging companies. He's building a vertically integrated God mode for AI. Knowing this, how do you play the X Holdings transition? First, look at the technical levels. TSLA has been choppy, pulling back from the $499 down to around $383, $437, 100-day SMA. This is your first line of defense. If it holds, the market still trusts the AI story. 383, this is the analyst's median target. If it hits this, the merger fear is priced in. 273, this is the line in the sand. If it breaks below this, the institutional bloodbath has begun. The bull case. You are getting in early on the Muskonomy conglomerate. You get a piece of SpaceX launchers, Starlink, and Tesla AI all in one. The bear case. You are getting diluted into a high-debt, high-risk venture where your fiduciary rights are secondary to Elon's Mars vision. When you boil it down, the SpaceX-Tesla merger is the ultimate high-stakes gamble. It's either the greatest corporate synergy in human history or a valuation reset that will leave latecomers holding the bag. The story isn't about Tesla failing as a car company. It's about the transformation into something much bigger and much more volatile. The real question is, do you have the stomach for the ride, or is it time to take some chips off the table before the X marks the spot on your portfolio? If you want to stay ahead of the X Holdings merger and get our deep dive analysis on the next technical move, hit that subscribe button right now and turn on notifications. Don't let the market decide your future. Stay informed.